This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, this is the second of two lectures on the basic techniques involved in discounted cash flow, and it's chapter 12 of the CIMA paper B2 notes. Now, in the first lecture, we looked at the basic NPV calculation and internal rate of return. And I hope I made internal rate of return clear that what it was doing was giving you effectively break even. And so when you're not sure about the cost of capital, it's very useful to see how much it could be wrong by. And there is, though, a problem with internal rate of return, which really is the fault of the way people use it. Just suppose I gave you two projects, A and B, and I asked you to choose between them. And I said they both cost the same, 50,000. And project A was going to last for 4 years, project B was going to last for 10 years. And I'd calculated the internal rate of return. And maybe A gives an IRR of 15% and B 14%. Now, strictly, it's not a rate of return at all. It's a bad name. It's just break even. But the danger is people look at that and say, oh, well, if I've got to choose between them, obviously we want the highest return, we'll choose A. But that's not necessarily the best choice. Think about if this was your money. A will give you 15% return, but only for 4 years. B gives you slightly less, but you'll be getting that return for 10 years. And it could be that B was in fact better. It's better to get slightly less return, but to get it for a lot longer. And the only time you could really say that A was definitely better would be if, as you got the cash in from A, if you were able to reinvest it and carry on getting 15% on it when you reinvested, then you could end up getting 15% a year effectively forever. And similarly, if B, as the money came in, you were able to reinvest and carry on earning 14%, then you could say A was better because 15% a year forever would clearly be better than 40% a year forever. Now, don't worry too much about that, except be aware that IRR effectively assumes that receipts can be reinvested at the IRR, which may or more likely may not be the case. And really for that reason, there is an alternative calculation, a different calculation. It's in paragraph 4, section 4 of the notes, called the modified internal rate of return, or the MIRR. Which, as you'll see, is actually perhaps slightly easier to calculate. But be careful. We've done normal internal rate of return, this modified internal rate of return. And to explain, and I will write the formula down afterwards, but look at exercise 4. A project has the following cash flows. At time 0, we pay out 1,000. At time 1, we get back 600. At time 2, 700. At time 3, we have to pay out another 200. Well, there are two steps to this. First of all, we calculate the present value of the outflows. So, easy enough here. There's an outflow of 1,000 at time 0. At time 3, another outflow of 200. The present value at the cost of capital, it says the cost of capital is 10%. So 1,000 now is 1,000. 200 in 3 years' time. The discount factor for 3 years at 10% is 0.751. So present value 150. So there's the present value of the outflows. We then calculate the terminal value of the inflows. Now the inflows, in 1 year's time we get 600, in 2 years' time we get 700. And I did show you earlier, at the very beginning, how to get a terminal value. In fact, we can do it two ways. Here I'll do it the way we did before because it's quick enough. But in case you ever got a longer example, I'll show you another way you could achieve the same thing. But to get the terminal value, we add on 10% for each year. Now, be careful here, this project does last 3 years. And so to get the terminal value of 600 in 1 year's time, we need to add on 2 years' interest at 10%, multiplied by 1.1 each year to add on interest. So the terminal value, the value in 3 years' time of 600, 600 times 1.1 squared, is 726. The terminal value of 700 at time 2, well, we want the value at time 3, so there's 1 year's interest to add on, which is 770, giving a total of 1496. Now, I don't want to waste your time. I did say there's an alternative. That didn't take long, but if you had a whole stream of numbers, the other way you can get it is if you work out the present value first of all. So the present value, discount at 10%, the factors are 0.909, for 2 years 0.826. $545, 700 times 0.826, 578. Is 1123. Well, that'd be the present value at time 0. Present value now. To get the value in 3 years' time, it's a 3-year project, the terminal value, simply add on 3 years' interest at 10%. Is 1490, well, 4.75. The difference is purely rounding. It wouldn't make any difference at all. I'm not worried about a bit of rounding. And what we do now, and I'll use the 1496. From a rounding point of view, that's more accurate, regardless. What we do is say this. For the MIRR, we say what rate of interest would make 1150 grow in 3 years to 1496. 1150, that, remember, is the present value of the outflows. What rate of interest would grow that after 3 years to 1496? Well, you'd multiply by 1 plus r cubed. R, the rate of interest, cubed because it's a 3-year project, would then be equal to the terminal value of the inflows. 1496. And then it's just calculator work. 1 plus r cubed is 1496 divided by 1150. 1 plus r is the cubed root of that, which is equal to 1.092, and therefore r is 0.092 or 9.2%. There's the modified internal rate of return. So there it is. It's generally lower than the ordinary internal rate of return, and the modified internal rate of return you could use to compare projects. This assumes that we're able to reinvest at the cost of capital. And of course, for this particular project, since it's less than 10%, we wouldn't actually want to do it. Anyway, there we are. Over the page, two special techniques when we come to discounting: annuities and perpetuities. And first of all, annuities. Look at example 5. A machine will cost £45,000 a year and is expected to generate 8,000. Sorry, a machine will cost 45,000, not a year. 45,000 is expected to generate 8,000 a year for the following 8 years. Cost of capital 15%. Calculate the NPV. Well, you could do it in the normal way, always. You could write it all down. Oh, it's 45,000 outflow now. 1 year, 8,000. 2 years, 8,000. 3 years, 8,000, and so on. And then discount at 15% for 1 year, for 2 years, for 3 years, for 4 years. No problem, try it, by all means. You'll get the right answer. But it is obviously rather time consuming. And also, all we're doing is each year multiplying the same figure by the discount factor. Well, because it's the same figure each year, instead of keep multiplying 8,000 by the factor for 1 year, the factor for 2 years, we could just multiply 8,000 by the total of the discount factors. I could just multiply 8,000 by the total of all the discount factors for those 8 years. Unfortunately, in the exam, you're given tables which gives those totals. Now, an equal amount is an annuity. That's what the word annuity means. Equal amount each year. And provided it's an equal amount each year, then again, rather than multiply 8,000 by each individual discount factor, we can get the same result by multiplying 8,000 by the total of them all. And so watch how we set it out and do it. It's a cost of 45,000 now. Instead of writing down 8,000, we just say it's 8,000 per annum, years 1 to 8. And when we come to discount, as always, 45,000 now has a present value of 45,000. The annuity of 8,000, well, this is why we've got the second table, discount table. It's headed up annuity table. And the figures there, again, for any rate of interest up to 20%, is giving you the total of the discount factors for any number of years. So, here it's 8 years. So if you look at the 10% column, was it 10%? Oh, sorry, 15%. If you look at the 15% column, and because it's 8 years, the 8-year row, that 4.487 is the total of the ordinary factors in the previous sheet for 1 year, 2 year, 3 year, up to 8 years. And so the present value of all 8 flows is 35,896. And therefore the net present value, well, here happens to be negative, at 9,104. It's negative, so you'd reject. But of course, that's an awful lot quicker, I'm sure you'd agree, than discounting 8,000 separately each of 8 times. By all means, try it, you'll get the same answer. But it is time consuming, however fast you're with your calculator. So if ever you find there's an equal annual flow, then use annuity factors. It only works when it's an equal amount each year. Just one thing to be careful of, look at exercise 6 with me. The cost of capital is 12%. It says, what's the present value of 20,000 that's first receivable in 4 years' time, and thereafter every year for a total of 10 years. So again, you could list them and say, oh, it's 20,000 in 4 years' time, 5 years' time, 6 years' time, and so on. But more sensibly, it's an annuity, so it's 20,000 per annum. The first receipt is in time 4. There are 10 in total, so you're going to get it in 4 years, 5, 6, 7, 8, 9, 10, 11, 12, 13. The last receipt is in 13 years' time. So there's 2 things to be careful of, and there's the first. It's tempting to put 4 to 14, 4 to 13, 4, 5, 6, 7, 8, 9. In total, there are 10 receipts. It's an equal annual cash flow. It's an annuity. So I am going to use annuity factors. The only problem is that the tables, they give you the total discount factor for any number of years, starting with 1. So it gives the total for 1 to 5 years, 1 to 10 years, 1 to 15 years. I want the total from 4 to 13. And so what we need to do is a tiny bit of workings. We can look at the total for 1 to 13. That's the 13-year annuity factor, which, what was it? 12%. So 12% column, 13 years, is 6.424. Now that's the total of all the factors from 1 to 13. 1, 2, 3, 4, 5, 6, up to 13. I only want the total from 4 to 13. And so to get the total from 4 to 13, we subtract the total for 1 to 3. If I subtract 1 to 3, I'll be left with what I want, the total for 4 to 13. Well, 1 to 3 is the 3-year annuity factor. And 3 years, it's, again, what was the interest? 12%. Is 2.402. And therefore, the total for 4 to 13 is the difference of 2.204. And now the present value is easy. 20,000 times 4.022 is 8440. So just be careful there. Remember, annuity factors are only relevant when it is an equal amount each year. But be careful when it's things like 40-13. Okay, now let's look at what you might call the ultimate annuity. Annuity, an equal amount each year. But the last bit is something called a perpetuity, where again it is an equal amount each year, but instead of being an equal amount each year for 5 years, 10 years, it's an equal amount each year forever. Forever. Now in real life, of course, nothing goes on forever, but it's for so long it might as well be. Let me show you how we deal with it. Exercise 7. A machine costs 100,000 and is expected to generate 12,000 per annum in perpetuity. Cost of capital 10%. What's the NPV of the project? Well, first of all, the way we write it, we've got here the original cost is 100,000, an outflow. The inflow is 12,000 per annum, but instead of being 1 to 5, 1 to 10, it's 1 to infinity. So you see what I mean when I say it is an annuity, equal amount each year, but the annuity tables only go up to 15 years. Here it's going forever. We want to discount it at 10, was it 10%? Yes. 100,000 now is 100,000, that's no problem. The annuity, well, I'll give you the formula, but then I'll explain why. The discount factor for perpetuity, rather, is 1 over R, where R is the rate of interest. So we write it as 1 over, that 10%, 1 over 0.1. We always multiply by the discount factor. But when you come to do it on your calculator, you're dividing by 0.1. So the present value is 120,000. Now, though a formula is a formula, and you've got to learn that, it's easy enough to apply, easy enough to remember. I'll tell you the logic. Just suppose you and I were married. Now, I suppose, I don't know whether you are male or female, but you know what I mean. Suppose I was married, and we've got divorced, and the courts have told me I've got to pay to my ex-wife, I've got to pay 12,000 a year, forever. Well, I don't want to keep associated with her. I'd rather just give her one lump amount now and then forget her completely. I found out that the banks are giving 10% interest. So surely instead of me every year having to pay her 12, why don't I just put 120,000 in a bank account for her? And at 10% a year, that will automatically generate 12,000 a year, and I can forget her. And how did I know I needed to put 120 in? I worked backwards. At 10% a year, to generate 12,000 interest, we'd have to put 120 in the account. Whatever, there is the logic, but there's the formula. And to finish it, the net present value is 20,000. And of course it's positive. We'd accept. Just one thing to be careful of, and similar to the problem we had in the last bit when we're dealing with annuity, is that the formula 1 over R is the factor when the flows are 1 to infinity. And so look finally at example 8. Example 8, the rate of interest is 5% a year. What's the present value of 18,000 first receivable in 5 years' time and thereafter in perpetuity? So it's 18,000 a year, but instead of starting in 1 year, it starts in 5 years. Well, we approach it in just the same sort of way as we did when we had that sort of problem with the annuity. We say, we know if it was 1 to infinity, there's no problem. Had it been 1 to infinity, the total discount factor for 1, 2, 3, 4 up to infinity is 1 over r, 0.05, which is what? 1 divided by 0.05 is 20. However, that will be the total from 1 to infinity. I only want the total from 5 to infinity. So we need to subtract the total for years 1 to 4. And how can I get the total for years 1 to 4? Surely that is a 4-year annuity discount factor at, in this case, it was 5% here. So if I get my annuity tables, here we are. 4-year annuity, the 5% column is 3.546. If I subtract that, the factor to apply for 5 to infinity is 4, 5, 4, 16.454. And therefore the present value, 18,000 times 16.454 is 296,172. There we are. Obviously that's the present value. You know, if I've told you the costs, subtract the costs, get the NPV, make the decision. But just that little thing to watch for. Good.